Hello guys, in today's video I will be discussing about type of currency risk. But before that, let us discuss what is actually currency risk. So currency risk is the risk that currency rates may go up if I have to make payment in foreign currency. Okay. Or let's take an example. Let's say today is 1st of December. Okay, and I have to make a payment of, let's say, $500 after 2 months. Okay, so obviously I'm facing the risk that after 2 months the currency rates may go up, right? The exchange rate may rise. So it means then I have to pay more in my local currency, right? Or let's take the case of receipt. Let's suppose I will be after 3 months I will receive a receipt of £300. So now in this case, I'm facing the risk that exchange rates may go down. So it means if it happens, if the exchange rates go down, so it means I will receive less in my local currency, right? So that is basically what that is your currency risk. Now we have three type of currency risk: translation risk, transaction risk, and economic exposure risk. Now first I'm discussing translation risk. Okay. Now first of all, if I talk about translation risk, so if I just talk about the term translation, so translation means to convert, right? So if you convert or if you translate, then only you will face this risk, right? If I convert or if I translate, then only you will face this risk. So this will usually arise when company have invested in foreign asset. Okay, let's take an example. Let's say you have purchased a car in foreign country for $10,000. Okay, I have purchased a car in foreign currency for $10,000. So if I tell someone that I have purchased a car for $10,000, so I will not feel the risk, right? Because I'm talking in terms of foreign currency. So I will not feel the risk. However, let's suppose I have a habit of converting those dollars into my home currency. Okay, now you will actually feel the risk when you will start converting them, when you will start translating them into your home currency. So that is when you will feel the risk. Like let's suppose today the exchange rate is 120. Okay, so you told your friend that that this car have cost me, let's suppose, 120,000 in Pak rupees. Okay, like so, and now let's suppose if in the future the dollar rate goes down. Okay, now if I using let's suppose if the exchange rate goes down to 110. Now if I translate using that exchange rate of 110, so now you will feel the loss, right? If you translate using the exchange rate of 110, so now you will feel the loss, right? You will feel that I have actually faced a loss. Okay, so the point is that you will only face this risk when you will translate. Or let's take one more example. Like let's say, for example, you have purchased a land in UK. Okay, for let's suppose I have purchased a land in UK for £5 million, and at that time the exchange rate was dollar per pound. The rate was, let's say, 160. Okay, now after 6 months, let's suppose the exchange rate rises to 180. Okay, so now you will say that okay, I have a gain. Okay, because using this exchange rate, if you translate this 5 million, so obviously you will feel that there is a gain, because at the time of purchase the exchange rate was 160. Okay, now it has increased to 180, so you will feel that there is a gain. But it could also be a possibility that after 6 months, let's suppose the exchange rate falls to 150. So now if I translate using this 150, so you will feel that there is a loss. Now obviously this is an unrealized gain or an unrealized loss, right? This is not in terms of cash. Okay, because until and unless I don't go and sell that land, I will not feel the risk, right? I will not feel the loss or the gain. So this is an unrealized gain or a loss. And this usually arises due to financial reporting requirement. Like let's take an example of IAS 21. So in IAS 21, if you have an overseas subsidiary, okay, so in group account you have to translate the subsidiary's net asset every year, right? Now obviously while translating, those net asset can increase or it can even decrease. Okay, so that is what, that is again your translation risk. When you're translating those net asset, when you're bringing them to parents consolidated books, so at that time you have to translate, right? So while translating them, the subsidiary's net asset can increase and it can even decrease. Now next I'm talking about transaction risk. Okay, now first of all, let us just talk about transaction. So transaction means normal buy or sell, or it means import and export. Since we are studying the topic of foreign currencies, I would use the term import and export, right? Because over here we are dealing in foreign currency, right? So dealing, if you're buying in foreign currency, so that is basically known as imports. And if I'm selling in foreign currency, so that is actually known as export. Okay, so over here we are not dealing in home currency, because if I deal in my home currency, then I will not face any such loss. I will not face any such currency risk. You will only face currency risk when you are dealing in foreign currency, right? Okay, so let's suppose if you have to pay 100 PKR in home currency. Okay, I have to make a payment of 1000 in Pak currency. So that is basically my home currency, right? So now I will not face any risk. So now I don't have any concern whether the dollar rate is increasing or decreasing, or whether the pound rate is increasing or decreasing. I have no concern with it, right? Because I'm dealing in my home currency. Okay, so now it doesn't matter whether the exchange rate goes up or whether it goes down. Okay, so you will only face the risk when you're dealing in foreign currency. Okay, now very good example of transaction risk is, let's take an example of your ACCA fees. So on your ACCA fees, you're facing transaction risk, right? Because you have to make payment in pound. So that is a foreign currency for you. Okay, so now you will be concerned regarding the pound rates, right? So if it goes up, so it means you have to pay more, and if it goes down, so it means you have to pay less. Okay, so even on your ACCA fees, you're facing transaction risk. Okay, now the third one is economic exposure risk. Now in economic exposure risk, we have two type of cases, right? So in the exam, you need to be a little bit careful that which case he is actually asking you to apply. Okay, so first of all, I'm discussing case one. So if I talk about FDI, foreign direct investment. So in case of FDI, company actually faces economic exposure risk. Now this is basically a long-term risk. Okay, now let me just discuss this thing in a bit detail. So like I said, that in case of FDI, you will be facing economic exposure risk, because in FDI, if you calculate your NPV, so first of all, what you have to do is you will be calculating your NPV in foreign currency, right? First of all, you will be calculating your net cash flows in foreign currency. Okay, like you will take the sales minus variable cost, fixed cost, all that stuff. So if you just minus from your sales, your variable cost, fixed cost, so you will get your net cash flow. Okay, so that net cash flow is in foreign currency. Okay, now I have actually deducted all the type of expenditure that actually took place in the foreign country, right? I have deducted all my costs, all my variable costs, my fixed costs. So whatever costs were incurred in that project, all of that has been deducted. Okay, so while arriving at net cash flow, I have deducted each and every type of cost. Okay, so now I will not keep that money idle over there in foreign country, right? I would like to remit that country to my home country so that I can spend that money. Okay, now the problem is that that net cash flow is in foreign currency, right? That is in foreign currency. So if I remit it to my home country, so now I need to translate it to my home currency so that I can actually go and spend that money. Okay, so I have to convert them into home currency. So in order to convert them into home currency, you need the exchange rates, right? If I want to convert my foreign currency into local currency, so I need the exchange rates. Okay, so over here, those exchange rates, they will be basically predicted. Okay, they will be estimated using purchasing power parity. You will calculate your exchange rate using purchasing power parity, and you will use those exchange rate for the purpose of conversion. Okay, now the problem is that those exchange rates are estimated, those are predicted, those are not the actual exchange rates. So it is very much possible that when the time comes, your actual exchange rate will be different from the one that you have predicted. So I have calculated my NPV using those predicted cash exchange rates, right? So just imagine that if the actual exchange rates are different from the one that you have predicted, so it means now my NPV will change, right? So NPV can basically change, it can decrease. Maybe before it was negative, sorry, before it was positive, and now maybe now your NPV becomes negative. So that can happen, right? So that is a risk that you are facing. So that risk is basically known as economic exposure risk. Now, how to manage this risk? You can manage this risk by using currency swap. So in currency swap, the exchange rates are fixed. Okay, so this currency swap technique is only applicable for the long term. So just imagine that if the exchange rates are fixed for me, so now it doesn't matter whether the rates are increasing or decreasing, right? So, because it is fixed for me. Okay, so now NPV will obviously not change. Okay, so that is one technique for managing this risk. So that was case number one of economic exposure risk. Now let us talk about case two of economic exposure risk. Now let's suppose my client is in abroad. Okay, and I have a history of importing goods from they have a history of importing goods from my company. Okay, that my client is present in abroad in foreign country, and they have a history of importing goods from my company. Okay, but now the problem is that my local currency have appreciated, it has become stronger. Like my local currency is Pak rupees, so let's suppose Pak rupees have become stronger, it has appreciated. So it means now the purchases from my country will become expensive, right? My purchases from my country will become expensive. So now basically the problem is that I might lose my client, right? They were importing goods from my company, right? So now that they will find my product expensive, so maybe they might purchase a product from the competitor instead. Maybe let's say they might purchase a product from China instead, because they will look for cheap products, right? Now they will find my product to be more expensive. Okay, so again that is also a risk. Okay, that my uh, the demand for my product may decrease if my local currency appreciates. So now the question is, how can we deal with this risk? What is the solution? So what you can do is you can try to reduce your production cost. Okay, but make sure that your quality is not compromised. Okay, so if I reduce my production cost, automatically obviously the price of my product will become cheap. Okay, or what you can do is you can try to go for proper branding or marketing of the product, because normally people are willing to pay more against the branded products, right? So you can go for branding or marketing of the product. So that is also one way of reducing this risk. Okay, so that was all from with this video. I hope you guys like the video. So do subscribe to my channel. Thank you.